Hello, fellow investors. Welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Nikolai Ray, and Nikolai is the founder and CEO of MREX. He's regarded as one of North America's leading experts in apartment investing, with over $1 billion in Canadian in analysis and transactions. He's a leading expert in multifamily financial engineering, and he's often called upon to stand in as a teacher, advisor, and speaker. He's also a real estate technology pioneer with his current work on multifamily real estate property tokenization with blockchain. Man, Nikolai, so happy to have you today. I think
Thanks
there's a ton to unpack. Yeah.
Yeah, that sounds like a mouthful, doesn't it? And it's like, that's all like kind of old stuff. I think 1 billion was probably like 5 years ago.
Oh man, you got to update your bio.
I know. Too busy.
You're too busy, right? No, yeah. I mean, I think there's a wealth of things that we can unpack today. So I'm really excited to talk. I mean, I think just talking about, I think explaining to our audience some of the ways that you, in a very advanced way, look at deals and how you analyze deals, and giving some insights into where things can get tricky, where things can go wrong, where maybe some of the benchmarks and some of the common things that we're used to maybe aren't the way we should really be looking at things. So I think really excited to dive in. But before we do that, let's start at the top. Tell the audience, where you came from and how you got to where you are today.
Well, I'll try to make it pretty short because it's actually quite a long story, but I was born in Quebec City in Canada, obviously in the French-speaking part of Canada, but I left with my parents when I was just about a year old, and ended up growing up in Los Angeles in California. So I spent my childhood in LA, was a Valley boy, learned some Chicano. So I speak English, French, and Chicano. And essentially came back to Canada in my teens, became a professional hockey player, and then also completed my education in exercise science and preventive medicine, and went to the Olympics 3 times as a human performance specialist. And throughout that, obviously, I have a very strong mathematical background, being in biomechanics in preventive medicine. And I always had this knack for obviously for math and for numbers, and always loved real estate, and thought that real estate was a great way, number one, for me to really express my mathematical prowess, but at the same time, create a bigger dent on the universe and a bigger impact on society than what I was just doing in the sports field. So around my mid to late 20s, I decided to actually completely leave my career of high performance and preventive medicine, even though I was at the top of my game at that moment, literally as one of the coaches for the Canadian Olympic teams, and went into real estate. Started a real estate investment firm. Essentially was a boutique investment banking firm specialized in real estate. And within a couple of years, we scaled that to $100 billion in transactions a year. Ended up selling that business. Went on to do some consulting work for family offices as their real estate arm, consulting work with syndicators, private equity firms, real estate investment trusts, and all that stuff. And ended up, I guess 4 or 5 years ago now, founding MREX and MREX College. MREX being a technology company where we're essentially building the equivalent of the Bloomberg terminal, but for everyday real estate investors. So retail investors, mom and pop investors, passive investors, obviously syndicators. And we've also built a college where what we do is essentially we bring very specific knowledge and frameworks to retail investors. So the idea is to kind of give you a Harvard level education specifically in multifamily investing, even though you are not in the Ivy Leagues, or maybe you're now a professional investor, or maybe you're a doctor and you just want to learn a bit more about investing. So I felt like there was a big gap to fill between the whole industry of conferences and seminars and what a lot of people will call gurus or mentors or coaches, right, and then the whole kind of college and university universe, which is much more built to build, for example, investment bankers and lawyers and stuff like that. But I felt like there was something missing in that gap there for just everyday retail investors who want to learn how to become a better real estate investor. So
Yeah.
that's essentially what I've been doing for the last 5 years. Obviously, my specialty is really in multifamily real estate financial engineering, and I've worked on pretty much every single side of the game, from active investing to helping passive investors, ground up development to complete redevelopment and optimization of actual existing multifamily properties. And yeah, that's the gist of it in I hope a couple minutes.
Just that,
Yeah, just
right?
that.
No, that's an incredible story, man. I didn't even realize all that about your background and the whole history of the Olympics and things. So thanks for sharing that. And and something that you said, I mean, it really strikes a chord with me. This idea of um, this lack of really an education source
Right,
for people that want to be real estate investors, right?
right.
Like, I mean, my personal experience, I was a finance and econ major in college. I even took a real estate finance class in college.
Yeah.
Um,
And that's a great base to have. Like
yeah,
that's
but it didn't really teach me any, like, nothing I learned in that class would I say am I really applying
right,
today. Everything
right,
has been self-taught,
right,
right? And so like there really isn't that avenue in a university to learn how to really successfully invest in real estate.
right.
Because even my real estate finance class was like, if you were like working for a large corporation that
Right.
invested in real
It's
estate,
very,
right?
very. It's aimed towards building investment bankers and
Yeah,
analysts,
you're building people
right?
that you're building
Appraisers, not
you're building
investors.
folks that want to
Doesn't
go
sort of
work in a
right,
large organization and
right,
be,
exactly. It doesn't give you that mindset of an investor, and that's kind of,
it
and,
doesn't.
and that's all fine and dandy, right? I mean, universities and colleges have their own specific vocation, and I think it's important. I think a college education can really help, uh, but I think we have to keep in mind that obviously people who are teaching it at these institutions aren't for the most part not active investors or active investment
Yeah.
professionals, right?
That's right. That's right. Well, I hope that, I mean, I often talk on this show that even though it's a passive investment, like you've got to be active in it. You've got to educate
Right,
yourself. And I think that, it sounds like you're providing an opportunity for people to do that, which I hope makes more accessible for folks. Hopefully remove some of that fear factor
right.
of jumping into real estate with a better understanding, and hopefully allows more people to get involved in real estate investing. And all the benefits it can have in your life, right? And
Absolutely.
everything it's done for me. So I'm always a proponent of trying to get as many people to invest in real estate
Of
as
course,
possible,
I
because I
think
think
the
it can
the
be life changing.
democratization of real estate is a very important factor because, I mean, I
Yes.
grew up poor. I grew up poor in the ghetto, in
Hmm.
in a ghetto in Los Angeles,
Yeah.
and my parents were artists, bohemian artists. My dad was a jazz musician, touring blues jazz musician,
Hmm.
which essentially means he was dirt poor. And my mom was a theater actress, so essentially was a waitress, right? Like every actress in LA. So all the research that exists in the world on climbing the social ladder and social mobility and equal access to opportunity, uh, you know two things always come out, and that's education, obviously,
Yep.
access to education, and the other thing is actually real estate. And there have been some really interesting studies done, especially on like the favelas in Brazil, which are just the
Yeah.
Portuguese word for ghetto, right?
Right.
And the moment that they started allowing the people who had been living there to actually become owners of where they're living, because favelas were always government owned, you started seeing people for the first time actually climb out of these essentially shanty towns and be
Hmm.
able to, pretty much change their go up the social ladder. So I think democratization of real estate, and that's what the mission of MREX is, through technology and
Absolutely.
through education, is to do that, to be able to say, hey, real estate's always been a very, kind of closed off big boys club,
Yeah.
which, even for say an accredited investor who say is a surgeon, even for that person accessing, for example, a multifamily real estate investment market and the
Mhm.
great returns that it offers in relation to the very little risk that pertains in that market, is a very
Right.
hard thing to do, right? It's
Yeah.
not that easy to get access to good deals and to good deal flow and to actually invest in that market. So
you've got to really know somebody,
right,
or you've got to really do your homework to find people,
right.
and then if it's somebody you're just finding randomly, you've got to do your work to build trust,
And then you have
right?
to
So
understand the market. You know, the
then you got to
multifamily
understand
market
what
is
you're
a
doing.
very, and when I talk about multifamily, obviously that's my prime business. But obviously we could talk about commercial and mixed use and whatever. But
Mm-hmm.
essentially, when we talk about the overall umbrella of commercial real estate, it's a very different type of investment class where, you know, it in part resembles the fixed income class of bonds and obligations.
Absolutely.
But at the same token, it also has resemblances to the stock market and actually to just business and owning, because essentially
That's right.
apartment building is a business, right? It's just a
That's
very
right.
simplified or
You're
dumbed
getting your
down
share
version
of
of
the
a business.
profits in the
Right,
business as an owner, right? So
right.
it really, and what you're saying, which I totally believe, it's the best. It can be the best of both worlds, right? You have the
Absolutely.
kind of the best aspects of both. You have the
And it
steady
can also
cash
be the
flow.
worst of both worlds if you don't know what you're doing.
If you, yes, exactly. So, no, I love that, Nikolai. I think that's a really good kind of lay of the land. I think the explanation, very fascinating about just the research around real estate being that, one of the common denominators to help people, climb to that next social class, that socioeconomic level.
Yeah.
Something else that you said that I thought was really interesting, I want to dig into a little bit more, is this idea of multifamily financial engineering. I mean,
Yeah.
that sounds like, it sounds like underwriting, like on steroids, right?
Pretty much.
So,
Yeah.
so tell us a little more about that. What do you mean by that?
Well, what I mean by multifamily financial engineering is essentially, I mean, financial engineering obviously it looks like this very kind of uh, big thing. A lot of people get very fearful when they hear about it, but essentially underwriting is just one part of real estate financial engineering, right?
Mm-hmm.
So financial engineering is essentially playing around with numbers, playing around with projections, playing around with all these different tools, mathematical tools, financial economics, to be able to mitigate risk, to try and generate alpha. So we're talking about like Jensen's alpha, trying to generate actual better
Mm-hmm.
returns by taking about the same amount of risk. So financial engineering allows you to play with different types of capital stacks, different levels of capital stacks, using different types of debts and levers and all these things,
Mm-hmm.
and really use a mathematical and analytical base to invest in real estate. And I think number one, financial engineering is probably the most important tool an active investor can use today, just because, I mean, let's face it, the market today is much tighter than it had been in the past, because it's gotten much more sophisticated, right? Investors today, syndicators, I mean, prior to 2012 and the Jobs Act, syndicating was not a word. Like, no one really
Right.
talked about syndicating. Now everyone and their mother is a syndicator, right? Everyone is
That's right.
much. I mean, everyone. I mean, if you go on Facebook, it seems like everyone has 8,000 units now, right?
Well, everybody has 1% of 8,000
Right,
units.
exactly, or 0.1%, which is fine. I mean, whatever, whatever rocks everyone's boats. But I mean, the fact of the matter is that now everyone's in the game. Interest
Mm-hmm.
rates have really bottomed out. Cap rates have compressed, and we're just in a different type of economy than what we had ever been in. And multifamily real estate and commercial real estate, but especially multifamily, has gone from a mom and pop investment class to a sophisticated investment class.
Absolutely.
So if you're working in a sophisticated investment class, you have to have the proper tools to know what you're doing and to make the proper investments, because the market is much more competitive now. I mean, if
Mm-hmm.
you're a mom and pop investor, let's say I started out investing tomorrow morning, I want to buy my first 24 unit property. I have to compete against some pretty heavy duty
Right.
opposition, right?
Right.
So I think you need that. And then as a passive investor, I think you need to understand financial engineering to understand what's being presented to you as a passive investor, right? Because now we have all these syndications. Obviously, syndications are not really, I mean, it's not like a public company. Like, nothing's audited, and no
Right.
one's really combing through all these operating memorandums and stuff like that. So as a passive investor, yes, you're passive operational wise, meaning that you're not managing the property and the acquisitions. You're just putting your deal into essentially a fund or a syndication. But you have to understand what is being done in these projections and the modeling to understand, what you're really investing in,
Yeah.
because, for example, I mean, I see this all the time. You see these syndicators like, oh, we're generating 18% IRR or 22% IRR. Okay. Internal rate of return is like the easiest metric to doctor. It's so easy. Like I can toggle one or two things and completely change the IRR of a project.
Yeah.
But essentially, it means nothing. Like it doesn't really mean anything in the project. So if you don't understand what are the inputs that are underlying that output and how they're
Yes.
affecting them as a passive investor, I mean, a very simple way to understand that is, the first thing that you can do as a passive investor is go and look in the modeling of the syndicator or the GP, or I mean, we can even get a higher level of a REIT and go and look at, okay, what is the IRR based off? Is it based
Right.
off an exit, so a disposition of the assets, selling the assets in 5 or 10 years, which is pretty common practice
Mm-hmm.
in modeling, or is it based off a refinance? So if it's a value add deal, maybe they're going
Right.
to refinance and pull you out, which is, I mean, it's a liquidity event, like a disposition, like a sale. So that's the number one thing. And then you want to look at is, what's that terminal value? What's it based off?
Right.
So, for example, if it's based off a projection that cap rates are going to be 3%, and the internal rate of return on the project is 18%, I'd be very weary as a passive investor to invest in that deal. And I'd be asking some very serious questions of how
Right.
that partner is arriving at
Right.
that output.
One of the things that struck me as I really started. So I love what you're saying. So, I was a consultant in my previous life, and I always thought about things as, you've got to understand at a basic level, like what are the different levers that
Right.
exist, and what are the outcomes that happen when you pull these levers, when you move it
Absolutely.
up or down, what happens, right? What's
Right.
the outcome that occurs, right? And so that's what you're talking about
And you don't
right
need a
now.
PhD in finance to do this. I mean, the first time
Yeah.
maybe someone hears what we're talking about, it might seem kind of,
Yeah.
over the top and very heavy, but it's
Yeah.
we can boil it down in a very simple way.
Well, and what I was going to say is the thing that really struck me about IRRs when I realized this and really started to understand these things was, what, one of the easiest ways to juice your IRR is actually pay more for the property, which lowers your ingoing cap rate, which will
Right.
in turn lower the cap rate on your exit, which
Right.
will improve your IRRs throughout the project. So
Right.
it's like, well,
Right.
you want to raise your IRR. In some cases, you could just pay a little more for the property. So just showing one kind of extreme example of how it can be manipulated.
Absolutely. And that's funny because I hosted a webinar last week on the four critical mistakes of what investors do with
Mhm.
regards to determining exit cap rates or reversion cap rates.
Yes.
And that's one of them, is basing your cap rate off your acquisition cap rate. Because what a lot of people do is
Right.
they'll take their acquisition cap rate and say, well, I'll just expand that cap rate. So I'll add on to it,
Mhm.
say, 5 basis points a year. So let's say
Yeah.
if you purchase at a 5 cap rate, that means in 5 years, your exit cap rate would be 5.25%, right?
Mhm. Yep.
But the problem with that is, like you just said, like that's so biased to the price that you paid for the property, right?
That's
Number
right.
one. And
That's
number
right.
two, if it's a value add deal, the cap rate upon acquisition means absolutely nothing. It means nothing,
Right.
because a cap rate is a metric based on stable cash flows in time,
Right.
what a value add deal is not and does not
Right.
have.
Right. Exactly. And a cap rate is really like a market level metric, right?
Right.
Your cap rate is driven by the market, um, which can be completely disconnected from what you decide to actually pay for the property and the
Right.
cap rate that you actually pay. It could
Right.
be a 5.5 cap market. You're overpaying for the property. You're paying a 5 cap for the property,
Yep.
and therefore that impacts everything you're saying. It impacts, if you're expanding, what your reversion cap rate ends up being,
Right.
and you're just over projecting it, in everything because you've overpaid from the outset. So yeah, I
And
appreciate that.
and there's another interesting point in that, and this pertains not just to cap rates, but to pretty much everything in real estate investing with regards to like metrics and data and all that stuff, stats. And I think like if anyone who's watching this right now, this is just like the key takeaway of this 30-minute discussion
Mm-hmm.
is just remember this. This is an old fable. I don't know where it comes from, if it's an Aesop's fable or whatnot, but it's the story of the 6-foot man who drowned in the lake that was 5 foot in average deep. Right. So you have to be careful when you talk about averages, right? Because
Right.
you could have a body of water that an average, it's 5 foot deep, but
Right.
that doesn't mean that it's 5 foot everywhere, right?
Right.
So the
Yeah.
6-foot man could still drown in that body of water, even though
Exactly.
the average depth is 5 feet.
Yeah, it's
And that's
15 feet over here and it's 2
right.
feet over here, and it's
Right, exactly, 1 foot over there, and
yeah.
that is really important to understand in statistics and data and metrics, because, for example, everyone talks about a cap rate. What's the cap rate in Dallas, or what's the cap rate? And I think you're from Indiana, right?
Yeah, Indianapolis.
Yeah, Indianapolis. So what's the cap rate in Indianapolis? It's 5%. Yeah, but that's the average. Like the cap rates in Indianapolis are probably like between 4.30 and 5.60. And then there's a whole bunch of different factors affecting where that property should be in that range, right?
That's right. That's
so
right.
that can be something that's extremely dangerous as well.
That's right. No, man, I love it. I mean, we could nerd out on all these metrics all day because we're kindred spirit here, but let's hit some highlights for folks.
Sure.
I think we could go real deep, right? But what are those key, if you think about those levers that make or break a deal or an analysis, what are some of those keys? We talked about cap rate, but like, what are some of those other ones that people really need to pay attention to and maybe often get wrong?
Yep. Well, I hope this is waking up a lot of passive investors to understand that even though they're passive, they can be passive in their education. Like,
that's right.
In fact, being a passive investor, you should probably even be more educated, or try to be more educated than the people who are the active investors. Because, I mean, what's the best way to get screwed by someone is being dumber than the guy trying to screw you, right? But the levers where you can really play around with things, obviously, I mean, underwriting, which is a part of financial engineering, is obviously the amount of debt that you're using and the overall weighted average cost of that capital, of that debt, is something that can completely change a model, number one. So right, because internal rate of return and NPV, and that's another thing, internal rate of return should always be accompanied by NPV, net present value. They go together, they're brother and sister. So if you're just talking about IRR in and alone itself, you're kind of missing part of, like, that's kind of like just the tip of the iceberg. So I think to keep in mind NPV is something very interesting, very important, because obviously the less amount of money I put into a deal, the easier it is to drive up my internal rate of return, right?
Right. Yeah. So explain real quick what NPV is for folks.
NPV is net present value. So let's say I'm putting in $100,000 into a deal, and I'm expecting 12% return. Well, if my NPV is at 0, that means I'm getting my 12% return, right? And my internal rate of return would essentially be 12%, because internal rate of return is essentially a metric that just says this is the return needed to make sure that your NPV is at 0, right? So if I have an NPV of which is positive, which is say, let's say it's $200,000. Well, that means I'm getting the return that I'm asking for plus $200,000 on top of that. So that's an important thing to consider. And in all these metrics, NPV, internal rate of return, return on equity, which is another one that's really, or equity multiple, which is a very popular one in the syndication world. Which is essentially if I'm putting in $100,000 and $200,000 comes back in 5 years, well, that's an equity multiple of 2, right? I've doubled my equity. But that's all dependent on essentially what is the exit value. So essentially, what's the cap rate or the refinancing value, what I call economic value. the value, the value based on which the maximum loan dollars amount will be considered.
Yeah.
And then obviously, what's the rent growth per year? That's a really important one that affects all these outputs, all these metrics that we talk
Yeah.
about. What's the expense growth, and what are interest rates doing? Like those are all very important things. And then finally, obviously, supply and demand in the actual transactional market, which will affect cap rates and values and stuff like that.
Yeah. No, I think, I mean, that's a good overview. It's you start with buying it right.
Right.
So purchasing at the right price, and then it becomes about the expectation. So how well do you understand the market? How much are
Right.
you expecting to get from your renovation from that bump, right?
Right.
How much are you expecting rent to grow organically, right? How much are you expecting expenses to grow organically? One thing I often see people just, I think, undervalue from an expense standpoint is insurance and taxes. I think
Right.
those are kind of, when I look at deals consistently in my mind, they're just underestimating how much those are going to grow over the
Right.
next
Well,
5 years
look
or
at the
so.
last couple of years, how
Right.
much insurance premiums have inflated. It's unbelievable. I
It's
mean,
been an
that's
incredible amount. Yeah.
yeah. And people have to understand that this is also good for kind of preventing yourself from getting into the wrong deals.
Yeah.
Also good to understanding that, oh, I might get into that deal, and it's actually probably a better deal than what the syndicator is indicating. Because let's take an example. I mean, the value of a multifamily property is essentially, if we boil it down and dumb it down, it's based off two things, right? It's based off net operating income, so rents minus expenses. What's left is net operating income divided by the cap rate, right? So what's that percentage cap rate that people are paying for in the market? That's essentially what a property's what the value is based off. So anything that affects NOI in the future and anything that affects cap rates in the future will determine realistically what the model looks like. So
Yeah.
let's say if I'm a syndicator and I'm syndicating a property in Memphis, and I project, 8% rent growth year over year. Well, if you're a passive investor, like that's the first thing that you should be looking at. What's the projected rent growth year over year? And then look at how is NOI growing year over projected inflation. Those are two simple things that you can look at. And in that NOI growth, obviously you look at expenses. Is the model projecting growth in insurance costs, in taxes and things like that? And that, but then on the other side of things, like for example, I live an hour south of Montreal, and then I spend a lot of time in Miami as well. But Montreal has been a market that has just it's been on fire in the last like 5 to 10 years, kind of like Phoenix and Arizona, very similar type of market. And Phoenix might be another good example, like Montreal is. If 5 years ago, as a passive investor, you were presented a syndication deal to get into as an LP, and the deal looked really good on paper, and you look at the projections and the rent growth projections were or the NOI projections were 3%, essentially 1% over inflation or 1.5% over inflation.
Sure.
Rent growth in Phoenix over the last 5 years has probably been like 8 or 9% year on year, right?
Right. Yeah.
So that deal actually ended up even way better,
right,
than the deal that was presented. And that's where understanding financial engineering is very important, because I bet you there's a whole bunch of people that didn't buy properties saying the properties were too expensive in 2015 because they were only projecting 2% rent growth year over year, even though they were in a market that was going to grow 9 to 10% year over year, right?
Yeah.
Now, that's a very dangerous thing, because on the flip side of that, you see it, people, project crazy rent growth or crazy cap rate compressions in just the wrong markets. Like in a Cleveland, where I see people, saying, oh yeah, cap rates are going to drop down to like 5% in average. I'm like, that's, I don't see the economic variables indicating that that's going to happen anytime soon.
Yeah. So it sounds like what you're advocating is really a more educated approach to actually understand the markets, and based on what's happened in the markets and history and what we expect to project the future versus using a lot of benchmarks that I think we're
Right.
all accustomed to as kind of shortcuts,
Rules of
right?
thumb
Yeah,
and
rules of
benchmarks
thumb.
are very, very dangerous things.
Hmm.
And I think like the best investment, whether you're on the GP side as an active investor, or if you're on the LP side as a passive investor, the best investment you can make in real estate investing is investing in your knowledge base. Like it's the return on investment on that is thousands of
Huge.
times better
Yes.
than any return that you can make in the market itself.
Yeah. No, I think that's a great point. That's a great point. And I think that's a good, I mean, that was a really good lesson. I think that you gave people some golden nuggets there about things to look for and stuff to watch out for. The one thing I would add is, where I see people, I think, get in trouble is you're talking about that, boiling that down to kind of NOI divided by cap rate.
Yep.
Based on that, that tells you how much the property should be worth. I think where people need to temper that is what's the reality of what things have actually sold for in that market historically?
Right.
Because what you'll see is, okay, the spreadsheet may tell you that the property should be worth 150,000 per unit based on where you can go with rents and things. But if nothing in that market has ever sold above 90,000 or 100,000,
Right.
then there are some limitations,
Absolutely.
in that. And that's where when we're underwriting, that's kind of our final look. We're saying, okay, well, it says all this based on our projections, but as we compare to reality, we actually need to cut that exit price by maybe 20,000,
Right.
be just to temper expectations. And that's kind
Absolutely.
of like our final check.
And also include all the disposition costs that come with selling a property.
Yeah.
And then also, if you're doing a refi rather than an actual sale of the property as your liquidity moment, the other thing you have to really consider, a lot of people don't understand this, is uh, financial institutions like banks and credit unions and Fannie Mae's and Freddie Mac's and all these, they don't necessarily finance based off market value of the property. There are some very important ratios, debt service coverage ratio, loan to value ratio. And these essentially create something that I call economic value, EV. And essentially, financial institutions will, in the majority of times, finance a property based off the smaller amount between actual market value and economic value.
Mm-hmm.
And in layman's terms, people will often say, well, I only got, let's say the property is worth $1 million. The bank is willing to finance, a 75% LTV. So essentially, normally you'd be able to get $750,000 in loan dollars, right?
Yeah.
But the banks finally capped it at $700,000. But that's because the debt service ratio was too weak. Because essentially, banks have actuarial teams, actuaries, essentially creating these risk management models, and that creates something called economic value. So in this case, what the bank is essentially saying is, yeah, market value is $1 million, and that's I'm sure market value and appraisal value is probably $1 million.
Yeah.
But us as a bank, our job is to take zero risk, or as close to zero risk as possible.
Right.
So we're underwriting this at a $900,000 economic value property.
Right.
Therefore, we'll lend you up to 75% loan to value based on the smaller number between the two. They'll never tell you this number,
Right.
but I found I found the equation that can help you know what that number is. So that's something that's very important to understand as well.
Yeah, absolutely. And it's about at that point, it becomes about the probability that you can cover your debt payment, right? And that's what that debt service coverage ratio is how much cushion do you have between your income and what you have to pay monthly on your debt payment.
You can never underestimate leverage in real estate investing, because it's a 60 to 80% leveraged market, right? Mm-hmm. We're using a lot of debt. We're using a lot of leverage. So if you don't consider that, you're kind of, forgetting a huge piece of the pie.
Yeah, absolutely. Well, this has been enlightening. I appreciate the conversation. Before I let you go, I want to talk a little bit about something else you're working on, though, because I think this will be fascinating, is this idea of real estate property tokenization and using blockchain in real estate. So tell us what you're working on there.
Well, it's still in its very nascent stages. Blockchain technology in a whole is very nascent. Obviously, a lot of people know about cryptocurrency and Bitcoin and all this stuff, which is
Yeah.
it's that's all based off of blockchain technology, but that's not what blockchain technology is.
Right.
Blockchain technology, the easiest way to understand it is like no one talks about cloud anymore. Remember like 10, 15, 20 years back, everyone talked about like cloud computing. No one uses that word anymore, even though we're all in the cloud using Dropbox and Drive and stuff like
Right.
that. So blockchain is just kind of the evolution of the transfer of value through the internet. It's a ledger technology, but the idea here is to be able to essentially, in the goal of democratizing the access to real estate investing, what I want to be able to do is create a NASDAQ of real estate investing. So to be able to say, rather than just have to kind of find a syndicator here and there or go on these crowdfunding platforms, I'd like to create a market where we have all these syndicators and companies and firms, and you can actually just go and buy shares in either a property, in either a fund or a group of properties, and then you have liquidity as well. Because, for example, crowdfunding is kind of the first step towards that.
Yeah.
But with crowdfunding, the problem is that you have no liquidity. So you're not really. I mean, because the two major obstacles to real estate investing, there are many obstacles, but the two major ones, or the weaknesses of real estate investing, especially multifamily and commercial, is number one, access to the market. You need a lot of money, right?
Right.
To buy a 24 unit property, you need maybe $500,000 in equity, right? Not everyone has that. To buy a small 6 unit property in most, metro areas, you're going to need at least $100,000 to $150,000 in down payment, which is a lot of money to put aside, and a lot of, to just put your eggs in the same basket, essentially, right? Because you have no diversification whatsoever. So access to the market's very expensive. And then on the second part of that is, once you put that 100,000 to your 6 unit property, or 500,000 to a 24 unit property, or maybe you've invested into a syndication, that money's frozen. Like if you have a rainy day, or for some reason, or you need to get out of that, that's stuck in there. You can't get out of that, or any of your gains won't be realized for 5 to 6 to 7 to 10 years, right?
Right.
So that's kind of where I want to go with that. We're really taking our time to build a solid foundation in technology. A lot of people have already come out with various projects in real estate tokenization and blockchain, because a lot of people kind of adhere to the first mover advantage, which I just don't believe in technology. And I think we're probably still a good 10 years out, maybe even 15, before like blockchain is mature enough and people are everyday average people are happy using that technology. But the idea is essentially to be able to say, well, if you can invest in a tech company and buy shares and have liquidity, well, why wouldn't you be able to do that with a ground up construction of a 100-unit property in Indianapolis, or a portfolio of 10 properties in Miami, right?
Right. Yeah. So the idea of this, again, like you said, democratization of real estate. You want to create a secondary market, right? Where you can actually trade these deals like you would trade stocks,
right?
And also in doing that, provide liquidity, the ability to sell your shares to someone else,
Absolutely.
right? At your preferred time. Now, extremely interesting. I think that's a huge idea. I think there's a lot there. And I think that will make real estate more accessible for people, which will ultimately hopefully improve the financial lives of a lot of folks. So more power to you, man. That's awesome.
Thanks a lot.
So,
appreciate it.
Yeah. Well, before I let you go, I want to move on to our keys to success. I've got a few questions I want to ask you, Nikolai. What is the one question that every investor should ask their deal sponsor?
Would you put your money into this deal?
Yeah. Would you, or maybe like, are you, right?
Yeah. Yeah. Well, in both cases, I think, I think question 1A and 1B, and, I can understand that a lot of people maybe don't have the equity to put money in every single deal they do, but, that's the first thing that I'd ask. And I'm an investor myself. I was a passive investor for most of my adult life up until about a year and a half ago. And then a year and a half ago, I got this, I don't know, I woke up one morning and decided to buy a couple properties, and I've actually purchased 30 apartment buildings in a year and a half with two of my buddies with just our own money.
Wow.
And I've slowly now started to accept a couple friends and family as LPs in some of our deals or in our JVs.
Hmm.
And every time I tell them like, hey, if I'd be willing to put this same amount into the deal as well. I'm not going to put it into this deal because I put it into that one or whatever.
Right.
There are different reasons why, but I would be willing to do it. And I'm willing to, to swear on my kids that I'd be willing to do that. I think that's a very important question to ask, and you're able to see like what is the level of conviction of that deal sponsor
Hmm.
by asking that question.
Yeah, very good. What are you most proud of in your career?
I went bankrupt when I was 25. So I started my first. I retired from professional hockey at 22, and started. I didn't realize I started a company, but I did start a company. I actually started two companies. So I had started a private health company where we had these clinics that were a mix of preventive medicine clinics and high performance gyms, so mixed into one. And I also started a real estate hockey agency where we repped hockey players. My first company within 3.5 years grew. Like we had almost 100 employees. We were in 3 countries, opening up in Paris and Sao Paulo in Brazil. And I just lost control of the company because I didn't really know what I was doing. I was 25, had never set out to be an entrepreneur.
Hmm.
Made a bad deal with an older partner who was supposed to be a mentor in the business world for me, and ended up kind of letting me out to dry. And essentially went from having nothing at 22 to 25 to being essentially a millionaire on paper, and then at 26 being homeless. And then, you know, just within probably about 4 to 6 months, got right back up and came back stronger. And ever since that, the last 10 to 12 years of my life have just been 10x the success I had prior to that. So be able to fall as hard and get up even harder, for me, is the thing that I'm the proudest of. And I think it shows resiliency, it shows passion, it shows that you can make mistakes and learn from your mistakes, but that you're also responsible, not a victim. And I think that's the key to success in anything that we do in life.
Absolutely. I think that's a great message. And what books should everybody read?
Man, I have a couple here. I have probably 1,000 in my house. So many great books, but I think I bet a lot of people here talk about real estate books, and there's some great real estate books, and but I think I think personal development and what you do with your mind and your spirituality is very important. I think any of the Wayne Dyer books, who's passed away now, are very, very important books. One that really touched me was it's called Inspiration,
Mm.
as well as way back when the seven spiritual laws, I think, of Deepak Chopra.
Mm.
Really good book. And there's a whole bunch of other books, obviously. Newer books like Tribe of Mentors by Tim Ferriss. I mean, I could probably give you a list
Yeah.
of 100 books. I wouldn't be able to put my finger on one, just on
Yeah.
one. I think there's just too
Well, you've
many.
given us some good ones to start
Yeah,
with.
yeah, yeah.
Good
I think
place
there's
to
just
start.
so many great books. One that really, really is great is The Untethered Soul.
Yes.
That's an amazing book.
Oh, awesome. Well, we got some good places to start. We'll come back to you once we get through those.
Awesome.
And then lastly, what is your number one key to success?
Number one key to success, I think, is having faith. Probably, I think faith is extremely important. Believing in yourself, believing in what you're doing, and essentially believing in something greater than yourself, kind of, in the background of that. Whether your faith is whether you're Catholic or Protestant or whatever your faith is. I think faith is an extremely important thing to have, and I think it's a key because that's what allows you to kind of, not become a victim, and have belief and vision. And I think without belief and vision, you can't achieve anything.
Yeah, fantastic advice, Nikolai. And Again, thanks for coming on the show. We talked about a lot of different things today. A couple takeaways. I think folks need to probably go back and re-listen to like the first half of the show, especially when we're getting nitty gritty into some of those things that you need to be understanding and looking out for as you're evaluating deals and underwriting deals and talking with sponsors, right? Some golden nuggets there. And Nikolai, if folks want to get a hold of you, how can they learn more about what you're doing?
I'm pretty active on Facebook, so you can find me on Facebook, Nikolai Ray. There aren't many of us. Just as I'm sure there aren't too many Kent Ritters. So
There's not. That's how I was able to claim
yeah,
KentRitter.com. There's
exactly.
not a whole lot of us.
Exactly. So I'm pretty sure Nikolai Ray, I'm the one and only. So Facebook, very active on LinkedIn, a lot less active on Instagram. I'm not into the whole kind of showing off kind of world, but I am there. And as well, the MREX College, you can find us on Facebook, on LinkedIn, and as well as on YouTube. We're just starting to put on more and more stuff in English because obviously we've been very, very active over the last 5 years in French.
Mhm.
We have a huge following. And we're just going to try and bring that even more to the US and to the English part of Canada as well.
That's awesome. Well, yeah, we'll make sure all that's listed below so folks can go down and click and get a hold of you. And again, Nikolai Ray, thanks for being here today and adding so much value. And hope to talk soon.
Thanks a lot, Ken. It was a lot of fun, and you did a great job. So,
I appreciate it.
anytime you want me back, we can always go deeper into any type of subject that you want. So,
That sounds great, man. I'll take you up on it.
awesome.